Okay, welcome everybody to Wall Street Reporter's next Super Stock live stream. Today is a milestone occasion. We have one of our first next super stocks about to become a super stock. I have the NASDAQ symbol up there. That's actually effective next week, next Monday. So that is the deal. It's the real deal right now. NASDAQ, watching this video next Tuesday, you'll be able to buy the stock on NASDAQ. Brad, congratulations on that, first of all.
Thanks, Jack. Appreciate it. I'm excited. Looking forward to it.
So this is, so you got great things starting to happen now. You got the NASDAQ next week, but right now, there's a bunch of exciting news. Today I want to kind of maybe start off with today's news about the clinical research aspect of the business, which is something we haven't talked a lot. We talked about it a little bit a few months ago because I think it's a very compelling aspect, which is it's incremental revenue. It's not your main business, but it's like a super high margin business, which is very valuable. It's like free money basically, which could be a huge business. I want to get into that. So for anybody that's just watching this, just give us a quick recap. In a nutshell, what is the business of Skylight? What do you do exactly?
Okay, yeah, for sure. So Skylight's a U.S. focused primary care and healthcare technology company. So our business model is really focused on this opportunity to take through acquisition and a very aggressive M&A strategy, acquiring primary care physician practices in the U.S., so family doctors' offices. And we basically benefit in two ways from this acquisition. One is sort of a public market value arbitrage, where we buy these practices very favorably, usually at less than 1x revenue. And then on the market, the multiples for Skylight are well over 5x revenue. And so there's immediate value arbitrage in this acquisition model from what we buy to what we're valued at. And then the second value arbitrage, which is really kind of the big growth model here, is we are able to bring in the technology and capabilities, and we help these practices change what's called as a reimbursement model. So the way that they're paid from health insurance companies. And that reimbursement change ultimately leads to like a 500% plus improvement in revenue from what these practices are doing. And so you can buy a practice for less than $2 million, and that practice has within it, well over 10 million plus in revenue potential just in this conversion. And this conversion is being led by the insurance companies. So it's not something that we have to necessarily validate and prove. These are proven models, and we've got major peers in the market today that are validating this every day. And what Skylight's doing is very much unique in its approach to these independent practices, bringing them together and then ultimately shifting them to this second value arbitrage. It's called the patient value arbitrage, that ultimately results in massive organic revenue growth for the company.
Okay, so I always like you to explain, start off with this model because it's such an exciting model, and in the opportunity, we've seen this. This is like, this is when people have this model that really in certain industries it really works when you have it like really set up like this, where you have like these double arbitrage opportunities. You have first you're buying them cheap, then you got the public. So in other words, you're paying 1x, it's really becomes worth 5x as a public company. Then organically, you're able to increase the revenues by 10x. So now you have, basically now you paid $1 million for a business that's worth 10 million, and that's generating 10 million in revenues. Now the market could value that at 10x, so 100. So essentially, you're like an alchemist. You can turn $1 million roughly into 100 million. I mean, more or less.
And if you look at our past performance, Jack, in the last 8 months, that's pretty much what we've been doing, right? And we've raised, with the last bought deal that we did, we've probably raised a little over $30 million now. And with a full execution of that capital into the pipeline, that's going to bring in north of 50 million plus in revenues. And that's just based on a simple acquisition model today. Now, in that model of acquisitions sits a potential for over 300 to 500 million in revenues from this conversion opportunity. And so, the cost of capital for us becomes cheaper and cheaper the more we continue to execute on it.
It's a virtuous cycle. I mean, this is what made like Amazon successful. Okay, so the existing business, what you have right now, could generate 300 million plus in revenue.
Just sitting on the existing patient base
organically.
And that's not even the full patient base. That's just a percentage of our current patients. So I mean, the full percentage is even higher. But even if we go with a conservative 20 to 30% of those patients converted, yeah, that's the potential.
Okay, so really, and the market could value this like 10x plus. I mean, and I want to address some of the comps, because now what's exciting, what makes this is such a great timing is you have a bunch of companies kind of in the space. There was some recent IPOs. There's more, so this kind of space that you're in is gaining traction with institutions. I mean, and you had that One Medical, you had the Oak Street, and you have a couple of new guys. So I think what that's going to do is that's going to attract eyeballs for institutions who are looking for, okay, how do we get in on the next one on the ground floor, which is still undervalued, on a relative basis, and which has the upside, and of course they got the great CEO, because it's really the CEO. At the end of the day, listen, at the end of the day, we can talk about valuation, I've been doing this a long time. It's really the CEO of any company. Yeah, you have a great CEO that can turn something which is, a piece of crap into, a blue chip, $1 trillion business. I mean, they can start with one business and become something. The business doesn't matter. So this is the great thing, which is, I mean, I think you're bringing a lot of value to this, and I think once you start doing that institutional roadshow, really getting out to more investors, you're going to be a superstar. I don't want this to go to your head. I'm not trying to, butter you up. I'm telling you the reality. Okay. So, what have you done lately?
Yeah. So look, I appreciate that, Jack, and I'll be the first to say, great CEO, but I wouldn't be able to do it without my team. So, we gotta go hands down to, one of the best possible 8 category teams we have on the, on the group today. And man, Q1 was just phenomenal for us in finding some exceptional talent on board. So like, I sleep better at night knowing that I got a team behind me that's going to continue to execute what we're going to do. But look, I think what a lot of people need to, I think what they see in Skylight's opportunity, and this, let's talk about this valuation opportunity that Skylight has just on the US side, right? So you're right. You've got companies like Oak Street Health, Agilon, Privia, and you've got more companies that'll come to market this year. Right. And there's really kind of 2 opportunities here. Number one, most of these companies are private equity backed. And so by the time they come to the market where the public can participate in these stocks, they're already valued at 5 billion plus. And so a lot of people lose that opportunity to get that 10x growth, through a company's growth phase. Right. And so Skylight's coming in at a $200 million market cap. And we have all the structure and sort of roadmap from our perspective to achieve what these companies are doing. Now, they've been doing it a lot longer, but as we continue to execute, you've got investors having an opportunity to come in on the ground floor. And that's really attractive, and that's not common, especially in healthcare companies on the US side, right? So that's number one. Number two, if you look at the valuation of these companies, if you're an M&A focused roll-up player, like a company like Cano Health today, they haven't gone public yet, but their values are at about 5 to 7 times revenue, right? But their value post-acquisition is barely nothing. It's just you have to keep acquiring to keep keeping your value going. But then when you look at companies like Oak Street and Agilon and Privia, and you see their multiples at north of 10 times, it's because of the organic growth they get. So if you look at the double opportunity that Skylight brings, as a roll-up player, you do get that valuation difference from acquisition. But then as an organic growth player, you do get that opportunity to now have investors and analysts value you on a much higher revenue multiple because of organic. And so this is why I think, just from a market perspective, there were always kind of 2 reasons why we felt here's why our stock doesn't compete against those of our peers. Number one, we're not on the right exchange. Number two, our revenue recognition today is in the fee-for-service model. And as we execute in the conversion of value-based care, you start to get recognition for that revenue. So we're achieving number one by getting onto the NASDAQ next Monday. And then we're going to be able to achieve number two this quarter, as we're going to start to announce how and these contracts are coming in and what these contracts are that are converting these patients over. And what better place to do it now on the exchange where our peers are receiving these much, much higher multiples. So we certainly think that this is going to be an opportunity, just from a valuation perspective, to see a closing of the gap.
Yeah, and I think so speaking of, so there's, I think an important distinction is, that investors need to understand is, there's, when people think about roll-ups or whatever, sure, the healthcare business is a huge opportunity. It's $1 trillion business in the US or whatever it is. There's a distinction between just doing, roll-ups, that's it, or where you're really driving that organic growth, because that's really where the value is. That's where, people are paying the top dollar. Speaking of which, you had today's news, which is the clinical trials business, which is, we haven't talked about that before. It's kind of something you mentioned back I think in February,
That's
we
right.
talked about a little bit, which
That's right.
I think is it's a phenomenal business, which, right now it's just a small part of it, but I think ultimately you have the platform, you really have a platform, because Skylight has this incredible platform where you could really make that a massive business, which, I mean, it could be worth more, it could generate more revenues than what you're doing right now by itself. I mean, it's a huge opportunity. So and this is your first deal that you announced today, right? This is the first actual contract. So we talked about it. We haven't really talked about it in the last few months. This is only we mentioned it. And
Yeah.
please explain what the business is, and then we'll go into today's contract.
Yeah, for sure. So, I think if you recall back in February, we talked about this partnership with ClinicEdge. And, I think what a lot of people, understand if you're in the clinical trial space and should understand if you're not is for any drug company that wants to introduce a new product in the market. Remember, our history and roots prior to Skylight spent a lot of time on the research side, right? So we have a lot of assets built already, and we have a lot of tools and capabilities from both a people and technology perspective to support companies on research trials. And so if you look at the cost and time that is the greatest in terms of a clinical trial, it is in the identification and recruitment of patients into a clinical trial, right? And the data access. And very early on in our sort of early debuts, I used to talk a lot and compare against companies that effectively have basically sold into drug companies for a value of data, right? And these values have been anywhere from kind of $2,000 a patient, and that's how you can value a patient base in terms of access points, right? And so I think the notion that this continues to still be a huge problem is identification and recruitment. You're right. We have a massive platform. And if you look at companies in the US today that run healthcare services, it's not uncommon to find that they're doing, in some cases, hundreds of clinical trials at the same time, because it's not like they themselves are the clinical trial company. They're just providing access to the patients through their network. They have a few amount of costs. Their margins are extremely high, and the drug companies pay for the majority of expenses tied to the clinical trial. But it's a passive revenue opportunity that's meaningful. And so, as we think about Skylight,
it's like you have this, you have an office building near a highway, and now you're able to put up a billboard. So the billboard can actually make you as much money in monthly rent as the space. It's like
so if you think about this partnership with ClinicEdge, I mean, the reason
it doesn't cost you anything, basically.
No, it doesn't. It doesn't cost. It doesn't distract us. It actually has us say, look, we're more so motivated to keep building the largest network possible because there's other opportunities that we can find to create, parallel revenue streams. And so if you look at execution from our side, we signed the agreement with ClinicEdge. We started on multiple clinical trial applications. I'd say today we've got, well over 15 applications with different drug companies. And these are companies that range from biotech companies all the way to traditional drug companies like Pfizer and GSK, right? And so the odds of winning these trials is very competitive. But there's so many of them that we continue to just maintain that ongoing pipeline of proposals. And so this first one that we've got here with Adagio, this is a biotech company. This one specifically is for an antibody test for COVID-19. Certainly not our focus, but a trial, right? So it's an access to a trial. And I'll give you an idea. This one trial where we have about 100 patients now for this trial, we'll expect, and although not reported, so far, but we'll expect north of $1 million in revenue on this one trial. Right, just this one trial alone.
And what kind of margins do you have on that?
Our margins are like 60 to 70%. So this is consider this one of 15 that we've applied for, and we're consistently applying for more trials. Now we may not get all 15 right away, but when you get one, you get credibility for the second one. And so I can certainly see that our research team are going to be pretty successful in at least getting a few more this year. And this is going to be, continue to be announced. Now, it's not to say that all of a sudden we're shifting to become a research company. No, it means that this opportunity only becomes more possible the bigger Skylight Health grows as a primary care network. And so it allows us to play in more opportunities for different types of drug trials. It could be a diabetes trial, it could be a cardiovascular trial. So, the notion that having this as a base of business, that we are now starting to prove parallel revenue streams, is only more meaningful to the organic growth potential of Skylight. This is a non-dilutive form of growth that is supported by the acquisition and organic growth story. So we're really excited because, it is with a major biotech company. It is from a grant perspective, meaningful revenue. Now, this trial alone, we only have 100 patients to start with out of one research site, and there's nothing limiting us from getting additional research sites under the same trial. So we could see the number of patients increase. And in fact, from a patient perspective, I mean, the remuneration is substantial, and it validates significantly the cost and the willingness for companies to pay for access for patient recruitment. So we're just really excited by the news. It speaks to the execution of our research team with their partnership with CliniEdge. And like I said, it's our team that's leading this way forward. So huge congrats to them, and I'm certainly looking forward to having more of these really good announcements this year.
Okay, so yeah, and again, the bigger your patient network is, the more it's a success cycle. So let's say right now you have about 100,000 plus patients in the U.S., right?
Yeah, I mean, we've got close to about 150,000 patients. Over 70,000 of those were probably brought in over the last 6 months. Actually, probably a little bit more than 150 now, but
okay.
Yeah.
And now, we're going to talk about the next topic, of course, which is the exciting one, is the M&A pipeline. But
Yeah.
so let's say when you get to 1 million patients, which is not really that far away. If you're at 175, it's only like a 5x. It's not a big leap. But at 1 million patients, all of a sudden you have a much larger database, which you can recruit patients into clinical trials. So how big do you think this clinical trials business could be inside of Skylight?
I mean, look, if you estimate it, I think that if we look at sort of future potential, like the per revenue patient in a clinical trial could be anywhere from a few thousand to 15,000 to 20,000 per patient per trial, right? So it's a range, but it's a substantial amount. I think it's fair to assume that if we put more of a heavy emphasis on research, and even today, if you look at it today, you've got 15 clinical trial applications out there. And the average revenue per trial is about $1 million a trial. Could you average about 15 million today on a base of patients? And as you continue to grow and have more of that credibility, because reputation allows you to get more trials in the door, and you gain more experience with the drug companies. I think this could be really a substantial form of revenue that, as we continue to build on the primary care side, I mean, today alone on potential of that revenue, it sits on a little less than 50% of our guidance for this year. I mean, that's pretty significant, especially something that has such high margins in a business model. But again,
I don't think it's
on the core.
And it's not really baked into the stock, because nobody has thought about it.
We don't put it into guidance. We don't put it into valuation. Really, it's one of those things that's just going to prove itself in the numbers as we start to report.
Yeah, it's like you're getting an extra. It's like a freebie right here. Yes, so a lot of, I mean, this stock has so many catalysts which can really drive that valuation. I mean, it's like almost too many to list. You have
and Jack, I'd say even from an organic growth perspective, even the conversion to value-based care, that's not factored in today. If you look at our multiples today on the business compared to the peers on the US side, we're receiving almost a little bit less than the valuation multiples placed on just M&A roll-up plays, not even the value creation. So, the way I see it today is value creation is not even baked into the multiples today. So I think that there's just a ton of opportunity, and broader audiences are going to lead to more exposure to that opportunity.
Okay, so let's jump into kind of the exciting thing that everybody wants to hear about is the acquisitions pipeline.
Yeah.
So again, that's kind of the big story is how fast, how big can you scale, Skylight with these acquisitions. So what's the latest? What's the update on the pipeline right now?
So, this has been a bit of a challenge for me, because you've known us. We've wanted to come out with news really frequently on deals, and I've had deals sitting in the pipeline that needed to have closed. But look, the administrational work required for the NASDAQ uplisting takes a lot of time. And more than anything else, I wanted to make sure that we have the right market, you have the right audience, and as you execute this cadence of acquisitions, you've got people that are going to pay attention to it. So, what I will say is we're getting impatient ourselves, and now that we have the NASDAQ date sort of fixed for Monday next week, and we'll be able to more formally announce that post Thursday after close, which is the 5th trading day that you're allowed to now officially announce the affirmative date, but they have put us in the calendar now for next Monday for trading. expect that we will be rolling out acquisitions starting next week. Now, we moved away from LOIs, right? So anything we announce now are going to be closed acquisitions that will reflect in that quarter on the P&L. So, I've got a little over 4 deals now that I need to close very quickly. And we've been sort of pushing and moving them along based on some diligence work and timing. And so, we're going to be, what I would tell people is, look, we've been holding off for a little bit because we had to get through this NASDAQ uplisting was the number 1 priority. But expect news flow to start rolling out next week, and expect a very steady cadence of news flow, very similar to how we used to do it before. I wouldn't be surprised if we doubled our number of acquisitions here before the end of this year. My biggest problem today is working with the team to make sure that we have enough teams in place to speed that up, because the number of deals in the pipeline are going to keep us busy well into the following year right now. So, and we're not even through the end of this year. So there's just a ton of opportunity. We're obviously well cashed up now from the last deal that we did. And so, we're going to go right back on M&A growth mode starting next week once we get this uplisting completed.
So going forward, you're not going to be announcing LOIs. You're just going to announce when the deal is closed, essentially.
Yeah, you know what? It's more exciting to announce closed deals. Look, LOIs have a sense of closing risk, and why do that? Plus, why? The other problem, Jack, for us is, we negotiate deals pretty much right until the close, right? And so once you announce a deal on an LOI, look, the buyers, the sellers kind of have you. So, we like the flexibility to be able to have that. And often what happens, Jack, is when we're in a diligence of a deal for 60 days, within 30, 2 might pop up and we go, you know what? We like those 2 better. And so we will be able to now move acquisitions around based on what we think is the higher quality target. And we're at such a large opportunity pipeline today that, quite honestly, we're sitting on quite amount of selection, right? We can be highly selective right now.
Okay. So we're going to jump into some audience questions in just a second. So the bottom line is, though, even though you have a couple of other companies coming into the space, they're going to be public, these private equity backed players getting into the healthcare space. It's still a vast, a vast open wide market. This, what is it, $1 trillion plus? Is there enough for everybody right now? Is there enough?
Look, here's what we get the best.
I should say, is there enough good potential deals for everybody?
Yeah. Because, look, no one's buying the guys we're buying, right? One of the bankers, and I don't say this to sort of hype us up, but one of the bankers, and I'm talking one of the larger broker-dealer bankers in the U.S., dubbed Skylight as a white knight for primary care clinics, right? Because they're like, look, you've got these independent practices. They're way too small to be acquired by these large, multi-billion-dollar public companies. Private equity doesn't care about deals that size. And really, these physicians are going, look, we need someone to come in and help us as a business make this move into this new reimbursement model. And there's really nobody there. And if you talk to the payers are going, our biggest challenge are these smaller clinics, because nobody's focusing on them. And so, look, I don't think we have a lot of competition in where we play. I don't see a lot of competition in where we play. When we go into these deals, everybody says there's other deals on the table. But we've only, knock on wood, lost one so far. And that was to a guy that had to sell his practice to a local hospital system because he wanted to continue working there. But, we don't have a lot of competition. So from our perspective, it's a wide open market. Even then, I've said this before, it's like an all-you-can-eat buffet, right? We're going to continue to be really aggressive here, but there's still so much room for everybody else to play. Because of that, the prices will remain disciplined. We can remain disciplined. And what we're buying isn't valued at the price we pay. What we're buying is valued at that 5 to 10x that we're going to turn this practice into by coming in and doing what we do with Skylight Health. So that's continuing to resonate. And that's why we're seeing the deal flow we're seeing, because it's proving itself out.
Okay, so right now, so just to recap, so the current run rate of Skylight is how much?
Well, on a run rate basis, I'd say we're about 56 million.
50, okay, so right now,
guidance we give the calendar year is about 40, but that doesn't include full year acquisitions that we've done, and that doesn't include the acquisitions we have in LOI today. That doesn't include the acquisitions that are sitting to get into LOI today. It doesn't include the organic growth that'll come from the conversion. It doesn't include any organic growth that comes from parallel revenue streams like the clinical trial business. So all of this is, the way I say it today is, if you're an investor coming into Skylight Health, what you're buying into is you're buying into an M&A story that has not been valued yet for any organic growth. And so we continue to validate. We've got the cash and we're going to make acquisitions. So you're de-risked from what you're buying. And then anything else you get in terms of organic growth is all kind of future opportunity that you're not paying for today. And so that's what I want to do. I want to make sure that everybody gets that opportunity to say, we're de-risked in what we're buying, and we have this tremendous upside if management executes on what they're going to do. And that's our model. We got to execute, and that's what we said at the start of this year. It's all about execution.
Yeah, and that's, it's funny actually. So when you first came onto our platform, I think was it in late November? So you've done everything you said you were going to do. I mean, we didn't even talk about NASDAQ. NASDAQ wasn't even in the cards at that. It was like, now it's going to be next week. Okay, so now one of the things you said you wanted to exit this year with a 200 million plus run rate. Are we still on track for that?
I think we already have that with our organic growth potential and our acquisitions done today. I mean, look, I'm sitting at well over 300 million potential with the conversions in our business. The revenues in the space are not little, right? When you've got companies like Oak Street posting 1.5 billion for the year, and they're sitting on what, about 89,000, 90,000 patients. By the end of this year, we'll have more than double that count of patients in our network. And while their revenues are tied to the older fee for service, remember those patients are Skylight patients. And as we convert them into the fee for service, into the capitation model that Oak Street plays in, those are the revenues that Skylight will start to recognize from the insurance company. So,
you want to, Pride? Why don't you repeat that comp once more? So let it sink into people so they can understand. So, OSH has been a pretty hot stock.
Yeah, I mean, so you've got Oak Street. So this year, I think they're saying about 1.5 billion in revenue is their expected revenue for this year, and they will do that on approximately 90,000 patients.
And you have 150,000 plus right now.
150,000 plus. I mean, by the end of this year, I'm pretty certain we'll cross 200,000. So, you cross 200,000 patients, and you factor in the fact that if even 10% of those patients convert into value-based care, we're talking about over 20,000 patients here. The revenue potential here is massive, right? And Oak Street has been doing this for 9 years. Skylight's been doing this for 8 months. So our rate of growth is so much faster.
I think that's the key thing. That's the real key takeaway. Is the story part of the story is the rate of growth. Is right. The dynamics of the story is that once it starts like really trading on NASDAQ, then it's like people say, wow, these guys are closing deals. They can model out that future revenue. There are those organic, so if you do 200 million revenues, potentially you could have a 2 billion valuation by December. I mean, 200 million run rate we're talking about. I mean, when you hit that run rate.
Yeah, I mean, look, I think that our multiple should be higher than 10x if we hit that kind of organic growth. I mean, where do you
because of the growth rate of the revenues, essentially.
Right. Yeah. This is a revenue multiple business. I mean, the 800-pound gorilla in the room, Oak Street Health, is a revenue multiple business. The company is posting massive losses every quarter. It's a revenue multiple business. Agilon, same thing. I mean, these companies are all being valued on revenue, and it's coming from the drive in organic growth. But keep in mind, most of their organic growth comes from value-based care conversion or acquisition of companies that are already doing it. So what's different between their model and Skylight Health's model? Nothing. The only difference is we're buying practices today that are unattractive to them. But these companies, if I buy them at a 4 times Ebitda multiple, and if my only business was to convert them and then sell them again, those guys would be buying them for me for 15 times Ebitda. So, that's just that's the price that you pay for a practice that's already made the conversion. So what Skylight's doing is just catching these deals earlier and realizing that potential post-acquisition.
Okay. So the bottom line is if you can get to that 200 million revenue, that run rate, you'd have a 2 billion. So basically it's a 10x from here because the market cap of a couple hundred million right now, 200 million right. Ballpark. So it's a 10x plus potentially in the next, what are we? We're in June already. That's 6 months. In 6 months, you could be at 10x.
Yeah, I mean, look, for me, I think
we've had stocks go up 50x in 4 months. I mean, I don't see why you can't go a 10x from here.
No, Skylight's already gone up 10x since, when was it? September of last year, more than 10x in September of last year. We're used to a certain pace of growth now, and we're going to want to make sure that we keep driving that. Look, at the end of the day, this is a market that has so much opportunity for growth. And the last 8 months, we have built a patient panel larger than some of our biggest peers in the market today that are valued at over $10 billion. And if you give me another 8 months, I will try and double that patient count for you. So, our goal here is to step down, focus hard on execution and make sure that, we're mindful of how we finance these things. We're mindful of how we utilize cash capital for acquisitions. And if at any point in time acquisitions is not the formidable form of growth, remember there is a ton of organic potential within this company as well that is actually bigger than any acquisition model that we can build.
Okay, let's see if we have. We'll go to a couple of questions, and I think we have time for like three questions here. Okay, let's go to Bob. I think he has another one. Okay, so Pred, how are you planning to fund the new acquisition, stock or debt?
So we've used stock most of the time now, right? I mean, we haven't raised any debt yet. One of the biggest differences between the Canadian market and the US market is Canadian debt providers use Ebitda trailing to be able to provide debt leverage. And so that's difficult for a growth company. The US market understands this market really well. In fact, one of the groups that we presented to was formerly senior executives from Oak Street Health. And they came over and started this debt lending business because they realized that when Oak Street was trying to raise money back in the day and they were losing money, they couldn't find it easily. And then all of a sudden, Oak Street did really well, and now suddenly you got these debt providers that are using enterprise value to be able to leverage debt against. And so, I think the turning point for us is the NASDAQ here. So crossing onto the NASDAQ allows us now to engage in these conversations with these US debt providers. That will be probably the conversation we will have now to start using debt complementary to equity. We're never going to use it as a primary form. And I'm expecting that based on demand on the US side, and keep in mind, we've had a ton of meetings on the US market, that we're going to have this continuous flow of growth. My job is to say, if we raise $1 million, I better get back 3 to 5 million in shareholder value. And then we use that to be able to continue to grow the company. We're mindful of dilution, but at the same time, this is a fast, rapid growth stock story that will be able to use future cash flows for acquisitions as well. So that's our plan moving forward.
Okay, Wayne's asking, when do you anticipate the revenue to reflect the organic growth from the switch to value-based care? When is that going to happen?
I think you'll start to see that this year in some of the reporting quarters, probably towards the back half of this year. Look, we've already started to receive offers from health plans for taking on risk-bearing contracts for patients we have, because we've started to focus on density and size now. We've already been approached by payer groups to say, look, we want to invite you to join our health risk program and take on risk patients. So really the question for us is, making sure that we have all the right structure in place to get there. And kind of like I said on yesterday's call, on our earnings call, we're pretty comfortable to say that we'll probably get our first contract in place this quarter. And then we'll start to see those patients coming into the third quarter. But keep in mind, the model for growth in the near term is still going to be very much focused on an M&A, because there's a large market share to be had. But we are also going to be working in parallel on this conversion shift as well.
Okay. Pred, are you going to be ringing, somebody was asking, are you going to be ringing the NASDAQ bell, the virtual bell?
I would love to ring the virtual bell. I would love to ring it in person. But man, is it painful to have to cross back into Canada again after. But yeah, certainly the goal will be to do it. But the best thing would have been to have done it in person.
Okay. Okay. Let's do two. Let's see if we can do two more. That and okay, because we're running a bit late. Expansion potential in California. You have any business in California?
So we actually have a few conversations in California. Actually, it's one of our big market opportunities that we're seeing. So look, we're in some major markets today: Texas, Pennsylvania, Colorado, Florida. Just name a few, but California is certainly on our radar as well. We have a few groups right now that we're having a discussion with around from an M&A standpoint. So we'll keep everybody updated. But yes, all eyes on California.
Okay, excellent. Pred, always great to have you back. Look forward to having you back maybe in about 2 weeks when you're officially on NASDAQ, and hopefully you might have some big announcements by then. So set the stage for the next level of growth. Okay, Prad, thank you again.
All right, Jack. Thanks for having me. Always glad to be here.
Okay, great news at Skylight Health. Let's get ready for our next exciting company. Let me just set this up over here. We got Reliq. Reliq, is Reliq going to be our next NASDAQ stock? That's the big theme today. Okay, so stand by. Let me just get this up here. Okay, Lisa.
Hello.
How are you?
Good. How are you?
Okay, great. You can hear me okay?
Yeah. Yeah.
Okay, let me just adjust. I'm going to adjust mine so we're at the same height. Or if you can tilt down your.
Hang on. I got it.
Yeah. Perfect. Okay, let me just make sure we have everything set up here. Okay, perfect. Okay, I got the symbols. The symbols, everything is spelled correct. All right. Listen, next time we have it, we just gotta make this NASDAQ so it'll be an easier symbol.
Yeah, no, I mean, NASDAQ is definitely a key next milestone for us. And I think, as I've said before, the key kind of precursor milestone to starting that uplisting process is hitting profitability, which we will do this month. So we're very close to the point where we can start our NASDAQ application, which is the...
Wait, listen, hold on. Save this for the interview. We haven't started. Yet. Okay. This is just the. So okay, I just wanted to get okay. So we got everything set up, and we got people. Okay. Yeah. Let me just do a quick intro, and then we'll do the official start. Okay. Welcome everybody to Wall Street Reporter's next Super Stock live stream, June 2nd, 2021. We're back with Relic Health Technologies, RHT on the TSX.V, Dr. Lisa Crossley, the CEO. Lisa, welcome back.
Thank you. Thanks for having me back.
Yeah, and for anybody that is just tuning in, anybody who's going to be watching this video, a month from now, our goal with these live streams is to bring you those companies which have that 10x to 100x upside potential. As I should even run this little banner thing at the bottom here. Like this. So we had so far 50x. Perhaps we're waiting for that 100x now, Lisa. So yeah, so we're looking for those companies which they have three things in common. One, going after massive multi-billion-dollar market opportunities. Number two, they're at a key inflection point right now, right at the threshold of explosive growth, and there's multiple catalysts in place which could ignite that shareholder value. So anybody watching, all those symbols you see at the bottom, those success stories, and we've had a bunch of others, they all had those things in common. And of course, Reliq also has those things. So Lisa, I think what we should do is, because I'm actually shocked that the stock is still, not reflecting where, the upside potential, and especially based on all the contracts you've announced. So I think we got to kind of, it's like a broken record. You got to repeat everything like 20 times before people finally catch on. I mean, this always happens, a lot of times with companies. So let's start off with explain to us the market opportunity that Reliq is addressing, and then we'll go into the traction you're getting. So what's the market you're going after? How big is this opportunity?
Right, so the $100 billion virtual care market for chronic disease management in the U.S. alone. So, it's a fairly defined but extremely large market. If you look at the Medicare and Medicaid component of that, it's excuse me, over 37 million patients. When you get into the private insured numbers, it's well over 50 million. So, excuse me. So it's just massive numbers, and it's a population that's historically been underserved from the perspective of effective monitoring or effective virtual care that actually reduces hospitalizations and ER visits. And so that's what we really deliver, is something that actually works and can serve that very large population that's currently not being served.
So, okay, so to start off with, the big picture is $100 billion addressable market opportunity in virtual health.
Yeah.
Do you want to take I'm going to take a drink of water if you in case.
Yeah. No, it's just I don't have COVID. It's just my asthma and allergies. This
yeah.
time of year.
We got the springtime here.
Yeah.
So the because the market opportunity is 100 billion plus. You have a unique kind of approach. I mean, like, explain, please, if you can just explain exactly what is Reliq doing. You know, talk about some of the contracts. How does all that stuff work? And you're based in the U.S., right? That's primarily U.S. is your main market.
The U.S. is our primary market by far. We do have some initiatives in Canada around First Nations in particular, and we are active, excuse me, in Australia. But primarily, over 99% of our business is and will continue to be in the U.S. We focus on what we call the community market. So community is really everything outside of the acute care space. So if you're not looking at someone who's in hospital or long-term care, although long-term care is not really acute either, but essentially it's everything outside the hospital. But what we really do is we bring healthcare into the home. So most of these patients are older, they're often living in remote and rural communities or very dense urban communities where there's not very good access to healthcare. They have these long-term chronic diseases that create these preventable complications, like in congestive heart failure patients, flares of the heart failure. In COPD patients, it's pneumonia. And diabetes patients, it's, you know, a whole range of different complications from stroke to kidney failure to blindness to amputations. But all of these complications are very preventable if the patient receives kind of daily coaching on their management of their disease, and more importantly, monitoring of the way they're controlling their disease. So things like looking at their daily blood glucose readings or blood pressure or peak flow, you know, blowing into something. And if they have COPD, weight, if they have congestive heart failure. And so we're bringing a new approach to healthcare and a new sort of power to the home. So in the home, we can monitor all of these different vital signs or biometric parameters, and then automatically alert the patient's care team if the patient is not taking their medication as prescribed, if they're starting to destabilize. And that allows the care team to intervene early with changes in medication or reminders to take their medication so that the patient can avoid those complications that lead to hospitalizations. So it's something that saves the healthcare system a lot of money. I mean,
and that's the big. I think that's the key thing. So basically, they're paying you, they're paying $50 a month per patient. So it's a subscription, approximately, right? That's $50.
So we receive in revenue anywhere between, at this point, sort of $40 US per month per patient to $100 US per patient per month if we're providing the full care management suite of services. So that's kind of the premium product.
Okay, and essentially with this monitoring, so it's essentially the insurance company, whoever's paying, they're investing roughly, let's call it, $1,000 a year. Let's just say $1,000 a year. But but the benefit for them is that they're avoiding potentially a very expensive hospital bill, which could be $100,000 plus, right. And which happens a lot of times with these high risk patients. So it's a good, it's kind of a no-brainer decision for the right. Provider.
The payers, in this case, let's talk about Medicare and Medicaid, they'll pay the healthcare provider $315 or more US per patient per month to offer this kind of remote monitoring and chronic care management. So we're only charging a very small fraction of that. It's basically all profit for the healthcare provider, or very significant profit for the healthcare provider. But investing that amount of money in patients for the payers, every time those patients go into the emergency room, because they are complex chronic condition patients, that's at least $20,000. And a lot of these patients end up in the ER quite frequently when their diseases are not properly controlled. When they go into the hospital, they're usually looking at an ICU stay of several weeks, and that's hundreds of thousands of dollars. I mean, it can be $500,000 for a congestive heart failure patient or a COPD patient with pneumonia. So the cost savings are really very, very significant. You can put thousands of patients on our platform and save that money by keeping one of your high needs patients out of the hospital for the year. And we've shown that we do that very effectively. So we're on average 20% of a chronic disease population would be hospitalized at least once a year. And that's not even counting the ER visits. We're able to get ER visits and hospitalizations down to less than 1% in the populations who are under our care, who are on our platform. So it's a very statistically significant measure showing that we really are saving the healthcare system significant dollars. And that's really why Medicare and Medicaid over the last 3 or 4 years have significantly increased their reimbursement models around this kind of remote chronic care management, virtual care, remote monitoring, where it started out at around $60 a patient per month, and now we're at over $315. And so they've really seen, based on data over the last few years, that they've saved a lot of money by kind of backing these programs. And that's the expectation from Medicare and Medicaid, is that, you know, investing $100 billion in this is going to save them trillions down the road. And that's really what they need in order to stay sustainable, in order to continue to exist as a payer in the US. And the insurers, same thing. It's the only way that they're going to be able to continue to profit, because that chronic disease population, we keep people alive for longer now. But that chronic disease, the percentage of the population is growing every year. So we really need to find a way to manage chronic disease patients. They're what account for 70 to 80% of all healthcare spending. So of that $3 trillion that the US spends every year, 80% of that goes to chronic disease patients. So if you want to move the needle on healthcare spending, it has to be by focusing on those patients. And the only way to really make change in their health outcomes is to provide that virtual care on a daily basis, the way that we do with our automated systems, including the automated voice calling and all of that, and to engage the patient and to really make sure that there's a safety net if they do start to destabilize.
So let's talk about okay. So the most important thing, I think, the takeaway is really, you know, I'm looking from the investor's perspective, is that, you know, the company's really in the last few months, you really started to gain a lot of traction. You've announced, you know, a bunch of new contracts. You know, kind of the pace has been accelerating really since, you know, March. You know, you're getting the revenues. You had the first, the quarterly results came out. I guess maybe people weren't that happy. They were expecting more. I don't know. The stock dropped for whatever reason.
Yeah.
You know.
Well, I mean, I'd like to address that. I think, you know, no matter what we do or say, people will always look at the quarterly results when we issue them almost as if they're a snapshot of the current quarter. And we have to remember that that quarter was January to the end of March this year, when the pandemic was still in full swing. So the US had started its vaccine rollout, but most of our clients were still spending 95% of their time dealing with COVID, either treating the COVID patients or in some cases with the remote health clinics, and, you know, starting to become mass vaccination sites. So they were not delivering their standard healthcare. And you see that in hospitals and other places, even up here in Canada, the backlog on things like elective procedures. You know, that's a massive backlog that healthcare facilities are going to have to work through. So while the pandemic was ongoing, we're a company that, from a healthcare perspective, prevents forest fires. And if you are in the middle of a raging global wildfire, you cannot focus on how you're going to prevent wildfires going forward. What you have to focus on is the current wildfire and getting it put out. And that's what was happening in the first quarter calendar of this year, is continued from the previous quarters. All of our healthcare clients were very much focused on just keeping their COVID patients alive. In this quarter, however, that's where we started to see the turnaround with our clients. So, you know, in Texas, for example, a lot of those healthcare providers are back to business as usual. Florida, which is not doing well with its COVID numbers, and maybe not so much, but, you know, we've seen significant growth this quarter, as we expected. Last quarter was not a quarter we expected to see growth. I was pleased that we did see a little bit of growth, but this is the quarter where it really all begins. So you talk about inflection points. I mean, we are literally weeks away from hitting profitability. And every quarter from here going forward, we'll see significant growth. We've always said that the bulk of our growth for this year will happen in the second half of the year. And that's still true. And I've been pleasantly surprised by seeing some growth this quarter. But you can already see, you know, there's a process to all of this. So there's, you know, the leading metrics, which are contracts signed, and then they're followed by onboarding numbers, so, and revenue. And so we've got a lot of patients in our pipeline. Right now, we have well over 250,000 patients that we are, you could sort of refer to them as a backlog. And so that represents, you know, I mean, that's $1 billion in revenue. So in revenue. So, you know, let me just highlight that again. That's a very significant.
200,000 patients, right? at, I guess, what is it, 1,000? What is it, 1,000 a year or
Yeah,
something?
you could say roughly 1,000 a year for the
Okay.
mix between the premium and the.
Okay, so that would be $2 billion in revenue. Okay. When do you think you can get to 200,000 patients?
So, I mean, I think there's a zero been added in there somewhere, but so it's at any rate. So we're expecting that by the end of this year, we'll have a minimum of 30,000 patients onboarded. Keep in mind that that number, because we report revenue for the month, pardon me. So when we report March, we don't recognize that revenue, and March's revenue until April, because April is when we do the reconciliation of the number of patients who are on the platform with each client for March. So, there's always that, that there's more patients on the platform than you'll see in terms of revenue recognized because of that month lag. And at a point where we are now, where we're growing very rapidly, that month can make a huge difference. So by the end of the year, we'll have at least 30,000 patients paying on the platform. So paying revenue recognized, but likely significantly more. And we will be doing a run rate of about 2 million a month by the end of the year. So we'll close the year at 24 million annually. And we've
so 24. So the goal is still 24 million run rate, and by the end of the year. Okay.
Exactly. Yeah.
Okay. And to do, I think you mentioned that 10 or 11 million revenues for in calendar year 21.
Yeah,
Okay.
we'll do roughly
US dollars, right?
That's Canadian dollars.
It's Canadian dollars. Okay. Okay.
So we'll do roughly 11 million in revenue this year, but I think the key metric is by the end of this year, we'll be doing, run rate of 24 million with Ebitda close to $1 million a month. So, little over 10 million a year for sure, and closer to 12. So, we're already getting into some very significant Ebitda multiples, and you're looking at a business that, similar to, if you look at, I think we've talked about them a lot, Teladoc and Livongo. Livongo was acquired at 70-something times revenue. And so the multiples are very significant in this space. And really where you get the higher multiples are where there's significant growth in the business. And we'll definitely be demonstrating very significant growth. So it's a big inflection point for us where we are right now. I think hitting profitability is one of those really key metrics. And what it really translates to for us is when we tell people we're not going to need to raise money, and we get a sense that people are a little bit disbelieving.
Skeptical, right? Because everybody says that. We've had companies say that they're not going to raise, then they raise.
Right. Exactly. They're a little skeptical, but legitimately, we will be self-funding by the end of this month. So we have no compelling reason to do an equity raise. And we can, if we needed additional funds, we can always borrow against receivables, and we have significant receivables. But we're not looking at a situation where we're going to need a big infusion of capital. We're not a hardware business. We're not in the M&A space. So this organic growth will be fueled by our own free cash that we'll start throwing off by the end of this month. And so we're in a very good position to move forward and to get to really significant revenues on our own dime, essentially, without any further dilution. And I'll sort of further say along those lines, to this point, we've compensated most of our business development and sales and implementation team in the US through stock options. But as we move forward and we're able to, post-COVID, starting this quarter and then accelerating every quarter from here, and turn those numbers, those contracts into actual revenues and patients on the platform, and those resources, those human resources in the US will be compensated by commission. So we're not going to be issuing share-based compensation the way that we have to date. So there'll be very little dilution for our shareholders going forward from share-based compensation, unlike the way that we've handled things to the point where we are now to sort of preserve cash. That's just not going to be necessary going forward because the revenues will provide sufficient commission income for our team down in the States. So I think there's a lot of very good things that are happening going forward. We're going to translate all of those contracts into patients on the platform, and there's going to be very, very little risk of dilution, which is always a good thing. And there'll be profitability, that's significant. Our Ebitda will be over 45% by the end of the year, calendar year, and that's a very significant metric in the space where a lot of these providers are operating at single digit or very, very, very low double digit Ebitda.
Okay, so just somebody had a calculator, so they did the math. So 200,000 patients, it's 200 million, because we're talking about we got the valuation mixed in with
there's a zero missing there, but the reason I say that 200,000 patients represents $1 billion in revenue is there's other sources of revenue from those patients. There's the premium services that we're offering. Many of those patients will actually receive multiple services from us, so they might be on remote patient monitoring, but also on chronic care management. So each patient long term, as we move forward as a company, has the potential to be more significant in terms of the average revenue per user than where we are right now. Right now we've still got sort of our legacy, lots of smaller clients who might be paying less and using fewer services, but we are starting to see more and more of our clients are looking for that premium product, that $100 per month. The other thing I would just remind our audience here of is when I talk about the revenue and in terms of what we recognize, that's in Canadian dollars, so 11 million Canadian. But when we talk about our pricing, that's in US dollars. So we're a Canadian company, we have to report in Canadian dollars, at least for now until we're on the NASDAQ. But in terms of our pricing, since our clients are in the US, then our pricing is in US dollars. When we say that we'll have 200,000 patients at let's say $100 per patient per month, just to make the math simple, that's US dollars. So when we convert that back into our revenue, you add sort of roughly 25%.
Okay, so I think this is kind of the big picture is that, okay, so the opportunity in within the next, I don't know, let's say 18, 24 months is to get to this 200,000 patients. And I
think over the next 18 to 24 months, the expectation is we'll work with our clients through that backlog. The backlog's not on our part. So when you work with healthcare clients, they are conservative. They have a very standard method for deploying new software, and it involves staged rollouts. And that's very typical. If you look at the way that an electronic medical record is deployed in a hospital system, it'll start at one hospital in, say, radiology, then it'll move to surgery. And so that's kind of the model that healthcare customers are comfortable with. We are finding that as we deploy and are able to actually demonstrate to the clients that there's significant financial upside for them to onboard patients, that picks up a bit over the standard, anticipated pace in healthcare. But basically, we have implementation plans with existing clients who are have patients under contract, such that we have that backlog, if you will, of the 18 to 24 month rollout for that large group of patients. So, certainly in 2022 and 2023, I expect will significantly exceed the guidance we've currently provided to the market. But that's something that we'll kind of address on a more granular level as this year progresses and as we get closer to those calendar years. But I think you can kind of do the math yourself. If you look at getting to a run rate of 24 million annually by the end of this year, a year that 3 to 6 months of which were really hamstrung by COVID, and that gives you a pretty good idea of how quickly we can grow. And certainly we're now at a point where we are working with much larger clients. So I think there's a lot of potential organic growth with this company, and because we'll be cash flow positive, profitable, over the rest of the year, it means that growth comes without the dilution that you might see with, for our business model is focused primarily on M&A.
Okay, so the takeaway. Okay, so this is the big picture. Now, one of the things is that essentially you had the companies had had some setbacks, delays. Hang on, let me just. Okay, so there's been setbacks, delays. The latest has been the COVID thing, which has basically set everything back in the whole healthcare world for the last let's call it 18 months now. So this is and I think probably a lot of people are frustrated with that. I know we have a couple of questions. People say, well, they've been saying that they're going to be doing this, for the last, X amount of years, and why is it going to be different now? And this is there's a lot. There are skeptics in the stock right now.
Yeah.
Now, what I should say is, I personally like situations where the company, has a big story, they have a big opportunity that they're addressing. But things take longer than they were expecting, and by the time that everybody gives up, that's what when we get involved in that point where everybody's pretty much given up. And I mean, we've had companies like that where I should run this banner at the bottom of the screen. Okay, so we have this. So some of these stocks which have increased 20x, 50x. These are companies that have disappointed investors for years before they got, and then all of a sudden things change. Things don't always happen in a linear fashion. And then when they do, that is the opportunity. And I think, quite frankly, Reliq is right now very similar to, I don't want to mention names, but a number of companies that have had 10x plus increases in the stock. So I think.
Yeah, I mean, I think if you look at when we started with patients, working with patients in 2017, 2018. 2018 was the first year that Medicare actually covered remote patient monitoring, and they had one billing code, and the reimbursement rate was $59. So the market itself has changed tremendously. When we started out, we were missionaries very much, and most healthcare providers weren't aware of remote patient monitoring or even chronic care management. There were limited billing codes, and initially Medicare and Medicaid were really denying a lot of claims. And they've since made it much, much easier to submit claims that are eligible. They've made the sort of re-enrollment, the pre-authorization much easier.
It's a little bit like Tesla, 10 years ago when they had problems getting the batteries to last. And the first Tesla lasted only 100 miles. Sometimes things take a little bit longer. I mean, I know the problem is investors don't, a lot of investors, they expect things to happen immediately. However, right now, this could be, this looks like it is actually, so I guess the real question is this finally it? Is this that breakout point, that inflection point where we're going to start to see? And I guess the main question is the onboarding. People are asking, when can we see the onboarding numbers? That's what they want, onboarding, right?
Yeah, I mean, onboarding numbers are something that are quite sensitive in this space. It's something that, competitors generally try to kind of keep confidential, but we'll share as much as we can. Honestly, you can do the math yourselves based on our revenue rates. If you use our average revenue per user, you'll have a pretty good idea of how many patients we'll have on at various points. We'll certainly be going forward providing targets based on quarterly targets in terms of revenue, and may be able to sneak some patient numbers in there as well. But revenue is really, people use patient numbers to model revenue. We're giving you the revenue numbers. It's that's really what you need to focus on, is those revenue numbers, and that we're hitting them. This quarter is extremely key to us. So this is a quarter where we finally, I said to my team when we were preparing for the quarterly earnings that we released this week, this will be the last boring quarter, in terms of our announcements. So, this is the last quarter where we were really slogging through the pandemic, and our clients were really very focused, not on proactive care, but on COVID patients. And going forward, this is when things really start to take off. So every quarter going forward, we'll see significant growth compared to the previous quarters. And, we've talked about the second half of the year is going to be really explosive growth. And that I expect will continue for years. And there's tremendous demand in this market, and we get more and more referrals from other clients every day. And, I think as the US, the nation, in the US in particular, kind of fully comes out of COVID, and some of that will come not even just from vaccination, but, states like Florida that have decided to just kind of let COVID be endemic. And so they have only 36% of the population fully vaccinated, but, they're just kind of going to get to herd immunity through a combination of vaccination and natural infection in the community. Over the next few months, those states are going to start to see a significant reduction in the burden on their healthcare system from COVID patients, even through that, maybe from a clinical perspective, less than ideal approach. So really everybody's going to be reopening and more focused on proactive care going forward. And if you talk to healthcare providers in the States, they're talking a lot about how hospitals are really going to be backed up for the next several years. And here in Canada, we're talking about a 4-year backlog on elective surgeries. So there's going to be continuing to be a very significant pressure on the community healthcare providers to keep patients out of the hospital.
Oh, that's a good that adds extra,
right,
a little extra oomph to getting which could drive revenues. Okay, so
right. And I mean, you should expect to see more and more Medicare and Medicaid using their stick on hospital readmissions and on length of stay. So more and more there's going to be pressure to keep patients in the community, which means keeping them healthier, and that's what we do. And we're really the market leader in that space because we offer all of the services that are now covered by billing codes. So where it started in 2017, 2018 with one billing code for RPM, there's now over a dozen billing codes for what we do. So we do both remote patient monitoring, chronic care management, transitional care management. That's a new code that's just over a year old. Behavioral health integration, which is mental health care coordination, as well as remote care for patients who have opiate addictions, which is a very relevant issue in the US and everywhere. We provide principal care management. So you've seen us sign contracts recently with nephrologists and orthopedic surgeons. These are specialists who, to this point, haven't been able to access any of these virtual care billing codes. So there are new codes for them that represent significant increases in practice revenue for them. And so there's a huge opportunity for us. And we are at a point where we are recognized as the leader in the space by the healthcare providers. They recognize that we have a platform that addresses all of their needs and that really fits the community space well. We work very well with the target patient population who are older, living below the poverty level in some cases, and have, not a particularly strong interest in slick apps and fancy devices, but just need something that, will meet them where they are, that works in their language. You talked with Prad about California and how important that is. We announced a big contract with California. California is still just kind of starting to come out from under COVID, but they'll be an important player over the rest of the year and beyond. And there we work with groups that are serving primarily the Asian American community, and it's a large and rapidly growing community. There's just a lot going forward where we represent something unique in that space because we offer a multilingual product that works really well with patients who may have either literacy issues or language barriers or are technophobes like my own parents. So we've got a platform that works really well for this particular target patient population who are quite challenging. And if you look at healthcare technology, you have to have a lot of very sophisticated technology and software that back your platform. But from the patient's perspective, it has to be something they can use. So for the younger patients, we have slick apps and fancy devices. But for the older patients, you have to have something that will work in a community with no internet access, and that doesn't require them to learn how to use a tablet or a phone or a computer because they just won't. And so we've been very successful with that. I mean, we have no attrition from our platform other than, or churn, I think some people would call it, other than if patients pass away and those patients are rapidly replaced by their healthcare providers with other qualifying patients. So we have really good adherence with our patients, which is why we get such good clinical results.
Okay, so essentially, I think that the story, the way I look at this story is this, right? I mean, you're looking at a huge market opportunity. The reason the stock is cheap right now, I mean, we could just address it, is people, this has been a kind of a pioneering company in this space, right? And how long? Again, I use the Teslas. I mean, using Tesla as an example because it's very similar. I remember seeing a Tesla in 2008. I think I don't know how long ago, but I remember seeing a Tesla. I was like, wow, this is like a piece of crap. And this was like when they had that roads, whatever. Yeah. I still think the car is stupid, but whatever it is. But they had issues then, getting the batteries, and they had all sorts of issues. And they had manufacturing issues, or whatever it is. But that stock, all of a sudden, they hit this inflection point where all of a sudden things started, the market caught up, the technology is caught up, and things caught up. And then all of a sudden, you have, one of the most valuable companies on the planet. And the same thing in this case is very similar. Like when you started, you didn't have the billing codes, the Medicare billing codes, which allowed you to make. So there's a lot of, basically you started really before the market was really available in terms of for sales, for reimbursement, and all that. So now it's available. You're finally things have. And then you had the COVID thing that set things back 18 months. So finally, you're at the right place at the right time. And this is, I think, the point where investors can look at this and say, okay, the market cap is what is it, like 70 million right now, 75 Canadian, I think, roughly.
Yeah, something like that.
Ballpark. So if you get to these, so I look at this, okay, if you get to this 200,000, patients in the system, you have a potential 2 billion market cap. So it's a 20x upside. However, I mean, that upside can kick in before you get to 200,000. I mean, I think if you get to 100,000, I mean, first of all, I think if you can overcome all the doubters, all the skeptics, and we have a lot of these skeptics online right now who've been in the stock probably for a while. So, and one of the questions is, okay, so they want to know is, I guess, what's the bottleneck? How are you going to overcome this? I guess with the capacity for the onboarding. How many can you onboard a month? How are you realistically going to get to this, $11 million revenues? Those are the big questions.
Yeah, I mean, we are not a bottleneck on our end. So really what has happened is the healthcare providers were constrained by COVID, and then they've got implementation plans that are fairly conservative. We expect that as we move forward with larger and larger clients, the implementation plans will be more aggressive. But we're not constrained in terms of the number of patients we can onboard. We can easily onboard hundreds of thousands of patients a month. So there's never going to be a capacity constraint on our part. And it's very easy to onboard patients. It's really just that kind of pre-work of, getting the healthcare organization to agree to an implementation plan, and then, having their buy-in and getting the patient lists from them. That's something that happens more slowly with the smaller clients, and we'd certainly started with the smaller clients. It happens much more quickly with the larger clients, and the larger clients are really what we've been announcing this year. So, by the end of this year, I think you'll start to see a much more aggressive rate of onboarding, but I still think, the onboarding rate is going to be quite impressive for the rest of the year, but it's definitely something that will scale by orders of magnitude going forward every year. And, it is one of those kind of snowball businesses where, you start relatively small, but it gets big quite quickly. And once it's big, it really is very autocatalytic and stays very big.
I think right now, I get the sense that a lot of investors, who've probably been in the stock for a while, maybe it's like, okay, they've kind of given up hope. It's okay, this is the onboarding. They're never going to get the patients, whatever it is, and that's the thing that's so. I think if you show at this point any kind of upside surprise, I mean, the small, in other words, the expectations right now are set very low for this. I mean, like with the current market cap and everything, it's basically the market has not very high expectations for the stock or for what you're going to deliver. So if you can show any kind of real traction, then all of a sudden people are going to say, "Wow, we better get on board before the rocket leaves to Mars." I mean, it's
I mean, if you think about it realistically, in my conversations with institutional investors, small hedge funds or family offices or small funds in general in the US, they're all waiting for profitability. That's kind of the key point at which they feel the company's de-risked. And we're very happy to be a show me company. And I think we're now at a point where every quarter going forward, we'll be able to really show the market and that, everything we're saying is conservative, and that we're going to hit these milestones and then some. But I do think that, what's going to happen is in the coming months, we're going to get a lot more institutional investors in the US because we will have hit that key profitability de-risking milestone. And those tend to be investors who hold for longer than kind of the stereotypical retail shareholder, although we've had some wonderfully patient retail shareholders who've been with us for a very long time. But I think that's going to eliminate a lot of the volatility in the stock. And I think the fact of the matter is, to this point, everyone has had to just kind of rely on our word for it, that, things are going to get better, that post-COVID, everything's going to fall nicely into place. But by the end of this month, you're not going to have to take our word for it anymore. You're going to have quantitative data around revenue and profitability that will show you that the company is delivering, and then that data will continue every month, every quarter, going forward for years, showing you significant growth. And I think the U.S. market will respond in particular to, demonstrating that you really are delivering. So, I think as we get more and more exposure in the U.S., which is our goal for this year, given that the U.S. is our primary market in terms of customers, I think we will start to see more appropriate valuations that really take into account the growth. And a lot of the valuations in our space and in healthcare technology in general are focused on, leading metrics. So, it's looking at the future.
It's I think, okay, so, it's interesting because you're coming on right after, right before you, we had one of our companies, one of the first companies from our platform that's going onto NASDAQ.
Yeah.
Actually in this year, we had a company that went to the New York Stock Exchange last year.
Yeah.
That was a Fubo,
yeah.
which, now when it's interesting, again, that was a company, when we introduced that company, it was called FaceBank, and people gave up. Very similar. It's the same narrative. I mean, I heard the story. This is like, broken record. So people gave up on that company. It was like, then they merged with this Fubo, which is the live streaming thing. And all of a sudden, that stock went to like $60 on the New York Stock Exchange. So I think the time to really look at these stocks is when, I like these things when everybody is giving up on something. There's skeptics, doubters, haters. And because then you have, as soon as you have some little traction, you get that, all of a sudden everybody jumps on. So,
well, and I think of, instead of thinking of it as, everybody hates it. That the way I always look at companies that are in similar positions is, if a company has been stress tested to this point and has still been able to survive,
that's why,
would have, they talk about the analogy.
It's been de-risked. Basically, I look at it as a de-risked. I mean,
there's been significant investment to date by other shareholders. If you're a new shareholder, that's gone towards developing the platform. That asset, has real value, and that's where the bulk of our funds have gone to date. So, any penny in has not been wasted. It's gone to develop that asset. It's also gone to develop our expertise around billing. We now have software that does automatic pre-authorization. So, we know when we onboard a patient that we're not taking our healthcare provider's word for the patient's eligibility. We actually have that in hand from the payer, so we know we'll get paid. And so, the company has, as you say, largely been de-risked. It's definitely had a trial by fire, maybe a few trials by fire, but it's not only survived through those, but is now at a point where, we're really poised for significant growth. And I think that speaks a lot to the team that we have and their talents. And I think it also speaks a lot to how much what we have is needed in the healthcare space, that despite healthcare being a very conservative market and the company having had some stumbles, which would normally scare off healthcare clients, we have and continue to build a very significant customer base because what we are delivering to the market is exactly what they need. And it's very financially compelling for the healthcare providers, but it's also, really good for patients in terms of health outcomes, and therefore very good for the payers in terms of controlling healthcare costs. So I think we're now at a point where we finally, are going to be able to be the show me company and show, consistent, significant growth every quarter going forward, and, profitability, which is a really key milestone. So I think this is, we've been talking about being at an inflection point, but we're really at that inflection point where we're literally weeks away from being past that inflection point.
Okay.
I think this is an exciting time.
I started talking about, I got distracted. I was talking about the case, but basically, so the first company right before you, we had
Skylight.
That's going on NASDAQ next week. I mean, and again, companies say, they're going, and this, they got the symbol. So next week is, although I'm sure right now people say, oh, it's never going to, but it's already been, it's a, okay. So the question is, what's your plan for NASDAQ? Because really, this is a NASDAQ type of story. I mean, if you were on NASDAQ right now, the stock potential could be 5x higher. I mean, just based on, that's the more receptive market. The Canadian market doesn't really understand this type of story. It's a U.S. thing mostly,
I think it's just, if you've grown up in the U.S. healthcare system, this this just intuitively makes more sense than if you've grown up in a socialized medicine system. So I think that you're right. The U.S. is the right audience for us, and certainly, NASDAQ is the right audience for a U.S. healthcare technology company. So our expectation is that we're going to start working on our uplisting, and that as soon as we are able to, we're going to uplist to the NASDAQ. That's our focus going forward, is that exchange. I think it definitely gives us the right audience, and that will give us the right valuation.
I would say, one thing that maybe I should tell you this off there, but basically, okay, so it is like, for example, I think in the case of like Skylight with the NASDAQ deal, now I think what's really helped push that process along quickly is the fact that they have their bankers like Raymond James, I think Stifel. And if you get, so I think it's like, if you can, and I don't know why. You'd be a perfect client for like a Raymond. I'm not on commission for Raymond James or any of these other guys.
No, but I mean, we
get a big U.S. like an Oppenheimer, like that's if you get those guys on board, that'll make the NASDAQ thing really a done deal, basically.
Yeah,
I think that's been the missing ingredient for companies that haven't made that.
Yeah, we work very closely with Canaccord Genuity and their U.S. partners. So, we're not lacking in investment bankers with expertise to help us with that transition to the NASDAQ. And certainly it's not something we're going to try to do on our own.
Right. It's not this month. I mean, it's not, but so let's say 6 months, 9 months out, it's a possibility.
Oh,
okay.
It's definitely, yeah.
Okay. So I kind of wanted to recap. Okay, so the milestone, we didn't even talk about the milestones over the last quarter. So the last 3 months, let's talk about some March, April, May contracts. Let's just go through everything that's been done, which,
Yeah, I mean, we've signed contracts with new specialist practices, and we are expanding our business with existing clients because they are finally able to not focus on COVID. So, for example, the remote health clinics and the federally qualified healthcare centers, they are large groups that serve primarily underserved communities. We've got 27,000 patients under contract with just a few of those facilities that we'll onboard over the next 12 months. And so we are finally able to get back to onboarding with some of those existing clients, but we've had a lot of interest from new clients, everywhere from California to Puerto Rico to Texas and Florida and excuse me, the Midwestern United States. So we've got a lot of new clients as well as existing clients who are finally able to get back to focusing on proactive care. So we have, a very good pipeline of patients that we can start to onboard. And of course, we're constantly signing new clients. So I think what you'll see, it may not have really resonated with people when we announced that we've adopted the FHIR standard, or the fast interoperability healthcare standard, but that's going to be required by Medicare and Medicaid beginning July 1st. So healthcare providers and payers in particular are going to have to support that interface in order to provide patients with access to their data. We have a FHIR-based patient portal, so we can work with these very large payers, the managed care organizations, private insurers, who have millions of patients. And we're uniquely positioned to work with them because we can provide that FHIR interoperability that effective July 1st, they're going to be fined if they don't provide. So, we've positioned ourselves as having something very unique in the market, particularly in the community care space, that serves these very large clients. So as the business moves forward, we're going to definitely be transitioning to larger and larger clients. So, the patient numbers will increase very substantively going forward.
Okay, excellent. On that note, I guess so. The issue is people want to know is the pace of onboarding. That's the big thing that people are going to be watching. So yeah. I would say let's kind of wrap up here. In terms of news flow, what can we expect in the next? It's the summer already. We're in June, so are you going to have an exciting summer, or what are we going to have?
We're not going to slow down in the summer, that's for sure. It's definitely going to be a very big summer for us, and we're very active in business development, and we've got a lot of, I think, very exciting news to come. So there'll certainly be significant news flow. I mean, it makes a huge difference to our business that we're at this point in the pandemic where the vaccine rollout has really been quite successful. So as we've always said, the second half of the year is going to be very explosive growth, and there'll certainly be very significant news flow associated with that.
Okay. What would you say that, like right now, again, let's to recap, and we always ask us, in your opinion, what would you say the top 3 reasons for investors to consider, Relic stock today?
Yeah, I mean, I think we are at a rare inflection point. So we're at a point where the company's really weeks away from being able to publicly disclose having been de-risked. But we've always said that that's what's going to happen at the end of this month. So I think relative to that milestone, we're tremendously undervalued right now. So this is a very good opportunity, to kind of get in and get a bargain. I think the company's in a market that's relatively new, but we're no longer, the pioneers who are getting slaughtered crossing the country. We're the settlers, and we're done that missionary work. We're at a point where it's something that there's a lot of market pull for. We're not having to push, and it's a very large and very rapidly growing market, at over 100 billion US per year. And I think we have something quite unique in that space, and we have the reputation and the credibility as the market leader. So, in the clinical circles, we're the first choice. So we're poised for very, very significant growth, and I think this is a unique opportunity to get in early in one of those stories.
Okay, excellent. Lisa, on that note, I want to thank you. Thank you, everybody, for joining our live stream today, and we'll see you on the next one. Thank you again, Lisa.
Thanks, Jack.